Hello, and welcome to this edition of the DC Bar Pro Bono Center's podcast series for nonprofit organizations, where we talk about the legal issues and practical challenges that nonprofits face on a regular basis. My name is Jason Q. I'm a staff attorney here at the DC Bar Pro Bono Center. You can find our previous podcasts, along with newsletters, legal alerts, webinars, and a bunch of other great resources on our website. That address is www.lawhelp.org/DC/CED. Okay, so our topic today is managing conflicts of interest, how to keep the IRS happy. Joining me is Regina Hopkins, Assistant Director of the DC Bar Pro Bono Center. Regina oversees the nonprofit and small business legal assistance programs here at the Pro Bono Center and has extensive experience in nonprofit governance and the laws relating to tax-exempt organizations. Before coming to the Pro Bono Center, Regina worked as a tax attorney in private practice before joining Habitat for Humanity International, where she served as Vice President and General Counsel. Hi, Regina.
Hi, Jason. How are you?
Great. So we have a big topic today. I think it's safe to say that conflicts of interest are a huge concern for nonprofit organizations and a major area of focus for the IRS. So we'll talk about all the ways that the IRS probes into how your nonprofit handles conflicts of interest on the Form 990, but sort of as a general conceptual matter, why does the IRS care so much about conflicts of interest?
Well, basically, all tax-exempt 501c3 organizations receive two benefits under the Internal Revenue Code. The first one is that their income is not subject to taxation. It's exempt. And although that is a characteristic shared by many nonprofits, including business leagues, political parties, and others, it is nonetheless a significant benefit. But perhaps the most important, and one that's almost unique to charitable organizations or educational or scientific organizations, is that donations to them are tax deductible by the donor. And what that means is that, in effect, the federal government is subsidizing your charitable contributions. So let's say you spend $1 on groceries. It's $1 that you may have had to work and earn $1.30 to have that dollar available to spend on groceries. But because charitable contributions are tax deductible, you only have to donate $1 for them to get $1. In effect, the IRS has wiped you do it in your pre-tax, not your after-tax. And that's a significant benefit to the individual, and as a result, it's a significant benefit to the charitable organization. Now, the reason why Congress allowed that deduction is because they feel that the charitable contributions are serving a public good, that the money is going to help people in need. For example, we've recently had some natural disasters. It's helping people who may have lost their homes or are in need of health care or some other type of assistance. And so the IRS and the Congress and the IRS want to ensure that once those monies go to the nonprofit, they stay there and they are used for the public good and not for anybody's personal benefit. And so that if you're an officer or a director, you're not getting rich off of the charitable contributions of others. That's what the IRS calls the private inurement rule. It should inure to the benefit of the general public and not to the private benefit of individuals. And so what the IRS is looking for is conflict of interest transactions where I'm essentially wearing two hats. I'm representing myself, but I'm also, in my capacity as an officer director, representing the nonprofit.
Right.
I have a conflict, and it's not clear that I would put the nonprofit's interest before my own, and therefore I may be using the assets of the organization for my benefit rather than for the organization's benefit.
Got it. So let's talk a little bit more about then the scope of like what we're talking about, the universe of potential interests that might be involved. So you mentioned officers and directors. We care about those folks. Is it because they have a lot of decision-making authority over the nonprofit?
Yeah, let's say I own a piece of property and the nonprofit is looking to buy some property because they want a new facility for their services. I could sell it to the nonprofit, and if I'm an officer or director, I could have a big influence on whether my property is purchased or somebody else's. And so That's why, I have the power and the authority to help direct the assets to me rather than to somebody else some other purchase, which may actually be better for the nonprofit than buying my land. So that's the idea, is that you have people, if I'm an officer or director, I have authority over the decision making of the organization, and I could use it in a way that benefits me.
And in some states, is that the same logic that applies to key employees as well?
Exactly. Someone who is an officer, the IRS defines officers very broadly. It's not someone who has an officer title alone. It's someone who acts like an officer. So that if you have decision-making authority out of an important function, like you're running a major department or a section of the organization, or you have a particular function, like you're in charge of all the finances or things like that, the IRS could deem you to be an officer, even though you may not have an officer-sounding title. You might not have a president or a vice president, but essentially you've got all the characteristics. It's one of those, if it quacks like a duck and walks like a duck, it's a duck.
Right. And it goes even deeper, because it's not just about my personal interests. If the nonprofit is considering a transaction or activity and it involves the interests of my spouse, that's included as well. So there's more to it than that.
Yeah, the IRS regulations provide that it's not just you, it's entities or individuals who may be related to you. For example, if it's your accounting firm that may be doing work for the organization, or your insurance company, or some other business entity that you're an officer, director, or you own, then they may be subject to the same rules as you are, because ultimately, since you own the entity, you'll reap the rewards of them doing business with the organization. Similarly, the IRS looks at close family members, like your spouse. Okay, assuming my spouse earns the money, it's the same as if I earn the money, and they look at grandparents, they look at children, they look at in-laws of those people. So they're looking at people who are very close to you in your family structure, and the same rules apply to them, because again, even if it's going to, say, your child, and you're not personally benefiting from it, you may nonetheless be influenced to direct the transaction in a particular way because it's benefiting a close family member.
Got it. So then, if my nonprofit is considering purchasing something from, let's say, X insurance company, how do I figure out who the people are who might have an interest in that transaction?
Well, the first responsibility is on the officer or director to disclose their potential conflict of interest. And the IRS takes a very broad definition of who should disclose and when. Basically, what they're saying is, if you have a potential financial interest, it's not your position to say whether it rises to the level of a formal conflict of interest, because you actually have a conflict in that. Okay, I'm like, of course it's not a conflict, no big deal. Whereas that evaluation should be done objectively. So the first thing you do is, the minute you see anything that even suggests that there could be a conflict, you should disclose it. And then it's up to the board or people who don't have that financial interest in the transaction to decide whether the interest is significant enough that it creates a conflict of interest. For example, I may be an officer of a very small company, and I may have a controlling interest of it. That's one type of interest. But I may be an employee, sort of a branch manager of Citibank, and you're thinking of getting a Citibank credit card. Well, it's not going to affect me in any real material way because I don't own enough stock in the company, and it's not going to impact my compensation. So the board could look at that and say, yes, you work for Citibank, and we're thinking of getting a Citibank credit card, but it's not important enough an interest that it gives rise to a conflict. So that's basically what the first step that the board or group of disinterested directors do is they determine whether the interest is significant enough that you have a potential conflict of interest. And then if the answer is yes, there's a whole lot of steps that you have to take to manage that conflict of interest. You can still do the transaction.
Okay.
The organization can still enter the transaction, but they have a lot of due diligence to do beforehand.
Right. So that's something important to emphasize, is that, you know, the first step is figuring out who might have an interest in this transaction. But that doesn't mean that everyone who has an interest in it is automatically blocked, that the transaction is automatically blocked. It just means that it triggers a series of steps and decision points that the nonprofit has to go through to sort of assess and manage the conflict and to see if it's still going to be permissible once they do that. So I think that's what's going to be addressed in your organization's conflict of interest policy,
right,
which is something that the IRS cares very much about.
Yes, the IRS wants every 501c3 to have a conflict of interest policy. In fact, when you file your application under 1023, it's a required attachment going forward. Mm-hmm. So they do, and in fact, on the Form 990, they will ask you if you have a conflict of interest policy. And so basically, if the board does decide, or the appropriate people decide that there is potential conflict, that there is a conflict here, the first thing the person does, the director or officer has a conflict, is that they say goodbye, not forever, but just for the purposes of the decision. They don't participate in the discussion mm-hmm. or the decision-making process. They are available to answer questions, but they're not there when the people decide whether or not to go forward with the transaction. They're not in the room because their presence could inhibit the free flow of information, mm-hmm. and they don't get to vote on the transaction. It is approved by either a committee of the board or the full board, provided none of them have the same conflict. Mm-hmm. And so what they'll do is they will then go through a two-step analysis.
Okay.
The first is this a good, is this something the organization needs? And the second is this the best deal? Okay. For example, going back to our hypothetical, you want to buy land for a new facility. Okay. You say, well, we need the new facility because our program is expanding and we reach capacity and we can't serve as many clients as we have. So yes, it's a good idea. It furthers the mission of the organization to buy a piece of property. Then the next question is this the property we want to buy? Mm-hmm. For example, you'd set up beforehand and you might have an evaluation checklist or something saying the property has to be so large, it has to be metro accessible, it has to be in this part of the city, mm-hmm. It has to have these types of characteristics. You decide what the criteria are, and you look at the director's property, but you look at others. You comparison shop, basically. Okay. You don't go to this property. You go and look at, it's like you go online, not literally, but what I'm saying is when you go to buy a TV, you may look at 4 or 5 different stores sure. to see to get the best deal. It's the same idea here. You're looking around and seeing whether this is the best price or the best location or it's best configured to meet your needs. And once you've gone through that analysis, if in fact the director's property it ticks the most boxes, if you will, mm-hmm. And it's not just price driven. It could be that it's a little bit more expensive, but its location is a lot better. Okay. You can go ahead and go ahead with the transaction. But what you should do is document the whole process okay. of what you did, what criteria you evaluated it, mm-hmm. What you looked at, how many other properties you looked at, mm-hmm. Why this is superior. And the other thing is the IRS wants to know is who participated in the decision, when the decision was made, you had a board meeting on this date, and this is how you voted, that sort of thing, and this is who was present. The IRS is very firm about wanting to see contemporaneous documentation, which translates into basically within 60 days. Okay. So that, in effect, you're not trying to justify it after the fact. You're in real time showing the process that you used mm-hmm. and why this was the steps you take.
So this is a case where we want really detailed record keeping.
Yes. A lot of times we talk about minutes and that you want minutes to be fairly brief and to the point, mm-hmm. but this is a case where the IRS really puts a premium on mm-hmm. being really laying it all out there so that they can come in, if they inspect your records, they'll see the whole process. because the IRS has made clear is that a year later, 2 years later, you're scrambling, you're trying to justify something. Your memory may not be reliable, so if you have really good records at the time. Now, there is situations where something may be a good deal, but you don't need it for your organization. Like, okay, so I'm a decorator, and I'm a director, and we've bought the new building, and I will redecorate the building for $50,000. It's a steal. I usually charge $100,000. I can show evidence that I would get $100,000 in fees, but I'm going to do it for $50,000 for you.
That's great.
Yeah, except that do you really need it? That's the thing.
Right.
Just because something is a good deal price-wise doesn't mean it really furthers the organization's mission.
Right.
And so that's why it's a two-step process. Does this further the mission, and is this a good deal?
Got it. Got it. Well, that's really interesting. So it's the board's job to decide whether the conflict is permissible or not, and we're going to have these steps, and they're going to use the standard, and we're going to record the process that we took,
right,
and really jot it down. I think an example of a conflict of interest situation that people are going to encounter very regularly, but they might not think of it as a conflict of interest, is executive compensation.
Exactly.
And that's one that we talk about a lot. So why don't we dive into that example a little bit more?
Yeah, the IRS, it's particularly a conflict if the person is on the board of directors, the CEO or whoever. But the IRS wants, and there is in the Internal Revenue Code what they call a safe harbor, because this is an area where the IRS thinks there's a lot of abuse, a lot of private inurement. People are being paid too much, and we're all familiar with a lot of scandals over the years involving the Smithsonian and the United Way and the like. So in order to address those situations, the IRS basically wants you to go through the same process of, yes, you have to compensate your employees appropriately, but you can't give them more than the market rate for their services. And so they do want you to do a comparison study. Look at what other organizations are paying similarly qualified people for similar-sized organizations with similar missions. So if you're hiring someone to be a head of school, what are other schools in your area paying head of schools? And you want to be in the general neighborhood of that market price. And so this is a case also where you have to show, these are the compensation surveys we looked at. These are the schools we compared ourselves to. This is what they were paying their heads of school. And so this is how we came up with the compensation package for our head of school, and again, documented carefully. And the one thing I should add, particularly with compensation, you got to do it in advance. They want advance approval. It's not something you pay someone 6 months and then say, oh my gosh, we forgot to document it, and then go around and do it. They want, before you decide on the compensation practice, they want you to go through and do your homework, basically, and figure out how much to pay people.
And this is another situation where the person who's getting paid and also people who might have an interest in that person's salary should be excluded from the process.
Exactly.
That's an important part of this as well.
Whether it's a relative or maybe another employee who maybe get more money, if the head of school is getting paid X and I'm the deputy head of school, well, I'll get paid more. The more he gets paid, or she gets paid, the more I may get paid. So people who are compensated, people who are supervised by that person, people who are related to that person, people who do business with the organization, and in our case, the head of school decides how much they're going to get paid. Anybody who could, anytime there is what we would call a you scratch my back, I'll scratch yours type of situation, that person shouldn't be part of the decision making.
Yeah, those sort of you scratch my back, I scratch yours is a dynamic that the IRS really cares about too, and that's why the IRS will also ask about independent directors on your board.
Right.
Just kind of without connecting it to a specific transaction, the IRS just wants to know generally if the members of your board have relationships with one another that might influence their decision making.
Yeah, one of the things that the IRS requires you to disclose on the 990 is whether there are business relationships amongst directors that may not, in fact, involve the nonprofit, but nonetheless could compromise their ability to be objective. Like, say one director loans money to another director for a personal loan. well, they could exert improper pressure on that other director to do or say something, vote a certain way or things like that. So, I mean, they're not saying you can't do that, but you have to disclose it so that everybody knows. All the other directors are aware that there is this relationship between you and another director, and that it may impact your decision. You're doing business together, you're partners in a real estate scheme, for example, or I work for you or something, or I've hired your organization. There are provisions where they, not de minimis amounts, but once you achieve certain thresholds, the IRS wants that disclosed if it would impact your impartiality.
Okay, great. So what are sort of the penalties of failing to abide by these conflict of interest processes and making sure that you do a good job of investigating and documenting?
Well, there is a penalty. The IRS has what's known as an excess benefit transactions, which is anytime I get more from the nonprofit that I'm giving in return. My land's worth $100,000. You give me $150,000. That $50,000 is an excess benefit. And under the law, I have to first return it. I have to give you the $50,000 back. And then there's 25% penalty tax that I have to pay the IRS. Not the organization, me, because I'm the one who benefited from the transaction. And if I don't do that, if I don't take those steps to correct it, then there's a 200% penalty tax.
Wow.
Yes, pretty high. And then also, if I'm another officer or director and I know that this thing is going on, but I say, look, give me $50,000 and I'll take care of you somewhere down the line, and they approve it, they are also subject to a 10% penalty tax for having approved an inappropriate transaction. And that's the same is true for excess compensation, anything. That's why, you want to make sure you're following all the steps so that people aren't going to be subject to these penalty taxes.
Yeah, so this is an area where there's a lot of personal liability, too.
Yes. And then if it's really abusive, the IRS reserves the right to withdraw the tax-exempt status of the entity itself. They prefer not to do that because there's, the beneficiaries, the people who are receiving services from the charity could be harmed. That's why they prefer. The first thing they'll do is they'll attach penalty taxes on the wrong actors. But that is an option as well.
Okay, so to help nonprofits assess their conflict of interest, we have a template conflict of interest policy on our website, and the IRS also has template policies. So we should point that out for people, that there are resources out there that they can use.
There's also the other thing the IRS wants you to do is they want you to review the conflict of interest policy, all the impacted individuals, to review it every year.
Okay.
So it's good at a session of the board of directors or a meeting of senior staff to go through the conflict of interest policy and just remind people of all of the procedures and steps that would apply. And they also want you to complete a disclosure form in which you say, this is who I work for. Like, I'm a director, I have a day job. This is who my day job is with. This is who my wife works with.
Okay.
I'm on the board of another nonprofit. Here's the name of that nonprofit. So that, because I may not be aware of all the transactions that are going on, but if I disclose it, then say the person who's the head of finance or the CEO or somebody can look at it and say, wait a second, we're doing business with them. And so that's why they want that all disclosed. And they also want you to disclose they encourage you to disclose whether or not there are business relationships between you and another officer or director that are outside the nonprofit.
That could be really useful for the organization, because then we're not just relying on officers and directors to disclose on a kind of ad hoc basis in response to each transaction. It's something that the organization as a whole can do kind of more proactively.
Exactly.
Like have a list of entities that might be impacted that we might have an interest with, and we can compare that whenever we're making a decision. Exactly.
I mean, you do have the obligation to disclose it on an ad hoc basis, but this is sort of a belt and suspenders thing. If I also disclose it on the form, then between the two of them, it's much more likely that it will come to people's attention that this conflict exists.
Great. And one more note about transparency, too, is that if you end up entering into a transaction involving an officer or director, even after you've gone through this process of evaluating the conflict and and determining that it's permissible, that's something that you still have to report to the IRS on your
Exactly.
Form 990 as well.
Right. There is a Schedule R, which is a form that you have to fill out whenever there's a related party transaction,
Okay.
where you disclose the terms of the transaction. Again, it's something that so the IRS can evaluate it. And they also ask for pretty detailed information about compensation as well.
Mm-hmm.
How much you're paying your senior people, how did you decide how much to pay them?
Mm-hmm.
And so similarly, that transparency, so that and it's not just pay, it's also benefits, like you're paying for a housing allowance, or you're paying for their membership in a club or something like that, total compensation.
Great. Well, thanks, Regina, for joining us today and for talking about conflicts of interest.
It's my pleasure.
Yeah, fantastic. Okay, and thank you for everyone for listening to our podcast series. We look forward to talking to you on our next edition.